even further. It's reducing risk with derivatives. Derivatives get a bad rep, or at least they have in the past, about being a higher risk play. Like, oh, I could buy this stock, or I could buy 10 times the stock in calls and really lever up. We want to look at options, calls and puts, and futures here today, Jermal, as a risk reducing endeavor, because I don't think it's talked about enough how essential futures and options can be to reducing the risk in your portfolio. And the most common basic go-to risk reduction is the hedge, right? And futures let you have a portfolio of thousands of dollars, whatever you got cooking in the background, Jermal. Risk comes out of nowhere with the recent geopolitical risk. And there will be, I'm sure, stories next year about some other risk. Hopefully this one gets diffused sooner rather than later. You perceive that risk. You can use futures to very quickly, in this particular situation, the small technology futures, I can get $5,000 worth of a stock hedge in there with one short future for just $600, just taking opposing positions. That's one quick way to reduce risk, right?
Absolutely. Helps you sleep a little better too. Better than I did last night. And again, that had nothing to do with trading. It just,
But yeah, the idea here is like, say I've got, a portfolio of 10 grand even, or up to 50 grand, 100 grand, whatever, of long stocks that I've accumulated. I'm reading the stories. I'm feeling kind of uneasy about everything. I can go with that 10 grand account. I can just like that hedge half of it if it's, primarily technology stocks, or we have other stock futures as well, with one short future. I sell the future there. I've hedged half my portfolio. I can sleep a little bit better, to Jermal's point. And then once I think the risk is gone, or maybe the market moves lower or what have you, I can buy back that hedge really quickly, shore up the $600 in buying power, and I'm back to full capacity with my portfolio. Now, a couple more interesting ways, as that's like the simplest way to reduce risk, and it makes sense, like just hedging exposure. Some of the other ways that I want to speak to, diversification, a word that gets thrown around a lot, but one go-to right now strategy for diversifying is simply buying flight to quality assets, non-equity assets like gold and silver. That's like kind of a longer term risk reduction, right?
Yeah. And kind of like what we were talking about earlier, this is the market where this works. People talk about this type of thing all the time. And a lot of times in lower volatility environments, it doesn't necessarily work as well. But right now, you're actually seeing it work.
Well, and that makes sense, right? Like when volatility is low, if I have, let's go back to that 10 grand account. If I've got $10,000 and it's all in stocks, and then I choose to let me actually shore up a couple thousand, convert that into small metals, which is gold and silver, or, interest rate positions in low volatility, my stocks are probably going to continue to do well, right? Volatility is low, fear is low, and my diversification, my long metals or long interest rates are probably doing whatever, not anything crazy. But the idea there is that when volatility goes from low to high, you tend to see metals skyrocket like they're doing as we speak, and your stocks are getting hit, but then your metals are doing pretty well. So it's a nice longer term diversification piece, and you can do so easily with the futures. Unfortunately, ETFs and everything, the stock world hasn't found a good way, a clean way, and a cost-effective way for you to add interest rate exposure or metals exposure. It's pretty clunky. Futures tends to be the go-to, right, for accessing commodities or just non-equity markets.
Yeah. And it's just more straightforward. I mean, a lot of those equity and ETF products, they don't necessarily always work the way you want them to.
Exactly right. They have drag and some other, they're also just costly. Like this metals market, you get, $7,000 of gold and silver for less than $1,000 in buying power. Now, let's get into something a little bit more intriguing before we head out for the day, which is going to derivatives and going to not only futures for, your short-term trades or your long-term diversification needs or your hedging needs, but going to options on those futures as well, just to reduce size, right? Like it's kind of a similar thought to the first point, which is putting on a hedge, putting on a short equity future to reduce the size of your long equity exposure. Same goes for like, if you're trying to trade the swings and you want to sell, a gold contract or a small metals contract, if you want to drop down that size, go to the out of the money options and sell, instead of selling that full futures, sell that out of the money call for at least the start of that position. It's, a third the size, or even if you're at the money, it's half the size of that futures contract. Reducing size is one of the best ways to reduce risk, right?
100%, man. Right on. You got it.
Absolutely.
I can't even
absolutely. I love it. I will continue to, I love to hear myself speak. So I will.
You're killing it with the trade today. You're killing it with the, keep going.
The last thing that I want to speak to, and this is something that you alluded to earlier, which is a lot of people don't think about as the first way to reduce risk, and it's not the primary risk reducer necessarily, but a nice way to get smaller and also get diversified is, instead of going to those equity markets and being like, oh, stocks are down, I'm just going to buy stocks a bunch of different ways. Putting on spreads is a nice way to get smaller and also just get into a different trade. Like, this is this SM75 versus the sticks, the small stocks versus the small tech, all equities, Jermal. But this pairs trade is at a high with equities down near their lows for the same time frame. So you're getting on a different trade, short one, long the other. At the end of the day, zero stock exposure. That's another way to get a different type of trade on. The whole point of today's segment is like, stuff starts to move. And if you're just in the stock world and like you've got a Robinhood account or something like that, you're just buying. And at the end of the day, you just got a bunch of long stock exposure. With derivatives and with the small futures, especially here, you get different exposures. You can reduce exposures with spreads and hedges and everything else. And that's the best way to reduce risk at the end of the day.
I totally agree. Yeah. I mean, I think this helps people to kind of understand this is a good time to get into type of a pair trade like this. And while we've seen these markets over the past, 2 years or longer, but definitely over the past 2 years where you just jump in and you buy, and, the idea of the buy the dip, I mean, I think that's, I don't want to say that's gone, but that's not necessarily the type of environment or the type of trade you want to do in this environment right now, all the way in, I should say. I mean, there's, you could sprinkle some of that, but, just be wary of the type of environment that we're in.
Yeah, you don't want to go 100% with any specific one strategy, one asset class. That's, I think, the more